next session, I know many of you are recipients already of our Best Practices of the Best Dealmakers series. Just over 18 months ago, we began this program in partnership with Merrill DataSite, and together we reach over 500,000 M&A professionals with the distribution of the electronic copies of our Best Practices reports. In September of this year, we released our Best Practices book featuring over 50 of the most active stalwarts in the industry who shared very candidly, for which we're greatly appreciative, of their insights into the best practices in our trade. I'm very proud to welcome this panel today of accomplished deal makers, facilitators, and contributors to the process. The session will be moderated by Marshall Sonenshine, who in fact has accepted the challenge of being the voice and the leader of our Best Practices program for 2014, which will expand beyond our summit participation, a new book that will come out in June, as well to include some smaller private salons, encouraging the conversation that we think it's important to share with our constituents at large about how we can be best at what we do. With that, Marshall, I'm going to hand the stage over to you to introduce your group.
Thank you, David.
Thank you.
Good morning, everybody. I'm going to say a couple of words quickly as I introduce what is, can you hear me all right? You probably could have heard me if I stayed in my seat. Best Practices says when you really start, you should stand up and organize the thing.
Marshall, it's not.
It's not
working. It's not working?
No, I can hear it.
Can you hear me now? What about upstairs?
Yeah.
Okay. All right. So I'm Marshall Sonenshine, as David said. I'm delighted to do the Best Practices moderation job. That's an easy job today because I think we have the best panel for the best practices. This is what I would regard as a SWAT team, if ever there was such a thing. I think one of the things that should be said about cross-border deal making and the global scene on which we all operate is that it is complicated and it has changed the game. For those of us who've been in the business for a while, I'm now in my 28th year doing mergers and acquisitions. One discovers very early in this business that if you have a passport and you use it, things do change just a little bit. And it does make life more interesting. Just in the last year or two, we closed, in my firm, we do mergers and restructurings as advisors to larger companies. We closed on the sale of a piece of Blue Cross Blue Shield to a company in Italy. We represented a German technology company called RTT and selling to a French technology company called Dassault. You may wonder what is a New York-based boutique doing in the middle of a French and German deal, but there we were. Before we could bring 1-800-CONTACTS private, we had to sell pieces of it in Japan and Korea to companies that many of you probably never would have heard of, and neither had we until we figured out who they were because we needed them. In China, we represented Alcoa selling what was essentially redundant manufacturing assets owned by an American firm, selling it to Yunnan Metallurgical in the middle of the worst recession, this was 2009, that the world had seen in 75 years. So we do weird things as a result of the global scene. What I thought we should have for a Best Practices panel are people who actually understand something about traveling the world with their toolkit. So I want to say a few words about who we have for that purpose. First of all, to my immediate left is my new friend, Nicole Lamb-Hale, who, among other things, is Senior Vice President of the Albright Stonebridge Group, which is the consultancy run by former Secretary of State Madeleine Albright. Nicole is a graduate of my alma mater at Harvard Law School, which she then put to work in the service of being a partner in Foley Lardner. I see Felix Sachs in the room, so we're glad to have Foley people. She actually ran the Detroit office, and I teased her that, and I said, that means you're a restructuring lawyer, and she said, that's not entirely true. We have she has also been, among other things, the Obama administration's chief for a number of purposes, including Assistant Secretary for Manufacturing and Services in the Department of Commerce, which is essentially the international trade business-facing unit of that part of the federal government. And she has also been the department's lead on the CFIUS, which we all know in the M&A trade is the Committee on Foreign Investment in the United States. It's been on the books for 20 years. It is the final screen against which certain deals will not actually happen unless it can pass muster with a mysterious black box called CFIUS, which Nicole actually has been on the inside of. To Nicole's left is one of the real stalwarts of this organization. Andy Rice needs very little introduction at M&A Advisors. Like me, he's a perennial hanger-on. He's always here. It's good. It's good. And like me, Andy actually has a long run. He's been in China for 25 years, which means he was there before everybody else was. He's been doing deals as a principal, buying and selling complex manufacturing, industrial, engineering, and other assets. He also has a distinguished record, I had forgotten this for the moment, in India and Russia. So he's got 3 of the 4 BRICS.
And Brazil.
And Brazil. So you got all the BRICS covered. So Andy is, you can't do a best practices for cross-border in this realm without Andy. So Andy, we're always glad that you're with us. To Andy's immediate left is Mike Henson, who is a specialist in the area of corporate communications, including in complex mergers globally. Mike is from Sard, Verbinnen and Company. He is formerly a managing director at Taylor Rafferty, which I knew as a British firm, but Michael corrected me and said it was actually a British-American firm, and so I said you were cross-border before you were anything then. He's actually American. And among his accomplishments include representing companies like Hess Corporation in its contest against Elliott Management, representing Manchester United in their IPO, representing GlaxoSmithKline in their acquisition of Human Genome, McGraw-Hill in their response to JANA Partners. A lot of activism in your world. So we'll have to come back to that topic because apparently it has infected the global scene.
It is increasingly cross-border.
And then we're very happy to have with us Brenen Hofstadter, who is a specialist in mergers. Again, a little bit, we have this in common, Brenen, you and I. You're with a boutique M&A firm, Generational Capital Management, representing middle market companies, principally on the sell side in deals, and find yourself doing deals in China suddenly. Maybe not so new in your world, but you were telling us that you've just represented a company in the heartland in grain agribusiness in Oklahoma, bringing them to China. So if you're bringing Okies to China, you know something about cross-border, and we'll be interested to hear about that. I want to start the panel with a few words from each of my panelists on what they're actually doing day to day. I gave you the headline, but I want you to hear a little bit about what this eclectic and very, very accomplished group of different types of specialists, advisory, investing, and even political. So Nicole, lead us off and tell us what the world looks like from the perch of the former secretary's office.
All right. Well, thank you so much, Marshall, and it's a pleasure to be back with the M&A Advisor family to talk about this very important topic. The Albright Stonebridge Group refers to itself as the work that we do as commercial diplomacy. And it's interesting because as I think about that work, when I was in government, that's exactly what I did. I was at the Commerce Department. I negotiated on behalf of U.S. companies on market access challenges that they had in various markets. As you can imagine, a lot of my negotiations were around kind of trying to stamp out protectionism and localization that you seem to see more and more. I call it the 21st century trade barrier. But what we do is we work to account for the non-financial risks in your transactions, and we try to mitigate those risks over the course of the transaction through your due diligence process, as you're approaching closing, and then even post-closing. We all are either former government officials or high up in the areas of civil society and business in countries across the world. We have a network of folks that spans the globe. There are about 50 of us in DC, but we have partners around the world. And what we do is really help you to design your transaction so that you aren't finding yourself as you're approaching closing in a situation where there are government actors or civil society actors that are trying to kill the deal. In the emerging world where we focus primarily, the government always has its finger on the scale. And so it's very important early on to incorporate that, and that's what we help companies do. Primarily U.S. companies, we do work with companies based outside of the U.S. as well. So it's a little bit different. I mean, one of the products that we find that our clients find particularly helpful is stakeholder mapping and then helping you to sequence your approach to those stakeholders. That's particularly important in markets like China, where we know that both on the national level and the provincial level, there are multiple stakeholders, and if you don't know who they are, they can come up to bite you at a point that you may not want to be bitten. So that's kind of a thumbnail, Marshall, of what we do, and I look forward to hearing the other panelists.
It's a little bit of a different spin on deal making because it comes from a political perch and a global financial perch. So we want to come back to that. Andy, tell us about investing abroad in the cowboy territories of the globe.
Thank you, Marshall. First of all, thanks again for inviting me here to the M&A Advisor. This is a great group. I always meet a lot of new people here. We're kind of unique. We were one of the first middle market private equity firms to set up an operations management support group, and we added an international team that I head up in 1989. And we've been, initially we were helping our companies export overseas, develop sales and marketing, distributors, sourcing, et cetera. And then very quickly it evolved to where we need to have local manufacturing. So we started helping our portfolio companies look at that. And initially we were only helping our US portfolio companies follow their customers overseas. So if one of our big US customers was going to Brazil or India or Russia or China, they wanted their US suppliers to follow them. My team worked with our operating folks to help them think through that. And so we would analyze, do we want to do our own greenfield operation, startup? Do we want to do a joint venture or do an acquisition? And about half of what we did ended up being acquisitions. It's the fastest way to enter the market, and these were all strategic. And so we were doing Russia, India, Brazil in the late 90s. We did stuff, Mexico, Czech Republic, Malaysia, all over. And then, and some of our companies were in fast-growing markets like telecom equipment where, you could just put your stake in the ground back in the 90s and, get your fair share of as those markets started to evolve. About 10 years ago, for a variety of reasons, we decided to focus our international support primarily on China. Russia had, we all know what's going on with Russia, the governance issues, things like that. Brazil, back in the 90s, would do great, and every 2 years their currency would devalue, or Argentina would get in economic trouble, it would flow over into Brazil. And then India, the infrastructure, we're manufacturing, distribution oriented, and India is just very, even now their infrastructure is way behind, China and other places. So we've been focusing on China. We've done over 35 acquisitions and joint ventures. Most are control deals. And about 6-7 years ago, we started to also look at standalone deals, and we've done a few standalone investments. We're very busy over there, and I can share some more a little bit later.
Good. Thank you for that. Michael, when you deal with large companies doing large deals, you need a large communication strategy, and I think that's what you guys do at Sard Verbinnen, but give us a little color on that.
That is what we do. And we work not just for large companies, we work across the market cap spectrum, and we also do work for private companies and private equity doing deals. We've been around for 20 years. We do sort of the public communications aspects of transactions. And by that, I mean communicating to the investor community and communicating to other third-party influencers, such as our friends in the financial press. We'll get brought in very early, ideally in an M&A, if it's a friendly M&A, to help the bankers and the lawyers in the company articulate what it is the strategy is. How do we want to talk about this deal? Is this a deal for growth? Is this a deal for scale, economies of scale? What are we trying to do here? So we'll work throughout that process up into and through the announcement in coming up with what the messaging is and bringing it out to the public. In hostile scenarios and shareholder activism, where it's a public negotiation over value, I think what we do is even more acute and important because we are, in a sense, the public litigators on behalf of our client. Our firm has ex-bankers, reform lawyers, financial analysts. I happen to be a philosophy graduate student who's looking for another place to argue, and this is where we do it. Historically, we've been just in the States, but we've done a lot of cross-border work. We just opened an office in London. I'm spending a lot of time there as kind of a call option on increased cross-border M&A, inbound and outbound into EMEA. And I think where we sit is we kind of sit among everybody sitting on this panel. I think the issues that Nicole talks about is something that we're seeing more and more of, is real deal risk when companies come in and try to do large cross-border transactions, or even small ones, where there are political or regulatory risks that aren't recognized by either the acquirer or their investors in a public company standpoint. So communicating all of that is becoming increasingly important. And we've recently seen some deals that we've worked on fail because of it.
So thank you for that. And we're going to come back to all of you guys. But Brenen, I want to mention, in some ways you're from the backbone of this organization's base constituency, which is good, solid middle market M&A work. But I shouldn't fail to mention that before you became a managing director at Generational, supervising principal, I should say, president of Generational Capital Markets and Management, you were a senior managing director at Citigroup. So that's an ultimate global firm. And I'm imagining that maybe you thought in going into middle market M&A in the safe confines of US and Canada, you would have a simpler, quieter life, and you find yourself doing deals in China. So give us a little bit of perspective about what's a nice guy like you doing in China.
Okay. Well, thank you, Marshall. And, it is true we're working with Chinese buyers. The case study I'm going to share in a bit was actually ultimately Japanese owners. But at any rate, my pleasure to be back. Real honor to represent generational companies here at the M&A Summit. A word about our firm and services, and then I'll provide a case study about a very recent transaction when it circles back to me. Generational is a Dallas-based company. We have about 250 professionals, mostly based in Dallas, but also in other offices in US and Canada. We market and sell privately held businesses in transaction values typically between 3 and 200 million. So we're in the lower, mid-market private M&A. And over the last 20 years, we've seen a trend where as our client size is increasing, we are seeing and attracting more cross-border buyer activity, initially from Canada and Western Europe, and now really globally. And so in a moment, I'll be happy to share a case study about a transaction that we conducted and closed last week that was cross-border. And again, appreciate Marshall.
Terrific.
You leading this panel, and looking forward to the next
Terrific.
round.
So before we get into the nuts and bolts of best practices, I want to get a little bit of perspective and idea flow from our panel about the global scene today in which we ply our trades, hopefully with best practices. We're 5 years or half a decade past the worst financial crisis, and truly a global financial crisis, that we have seen in, I think, 75 years, because I measure it since the 30s, but Alan Greenspan said it's a once in 100-year event. We'll see whether that's true. But where are we in global financial markets from a strategist and corporate deal-making perspective? Is the upended upended and unsettled? Are we in a revisitation of a kind of Cold War between the United States and Russia? Are we in recovery mode, in fact, in this country? Where are we? What's the global financial marketplace? Nicole, give us a little bit of wisdom on that.
Sure, and I really want to talk about some global trends that we're seeing. I mean, certainly the Ukraine situation is one of the ultimate geopolitical issues we're dealing with now, and the impact that, quite frankly, escalating sanctions could have on the work that we all do in this room, because to the extent that the next hammer comes down and it's sanctions on a sectoral basis, it's going to affect the global supply chain in the world, and it will impact every one of us. But there are a few trends that I want to focus on. One is kind of the increased social pressure that's emanating from the growth of the middle class around the world. In the emerging markets, that creates opportunities and challenges, and I think that we should really celebrate that, because it's going to allow us to make the money that we want to make, because as the middle class in each of these emerging markets is increasing in size, there's an increasing demand for goods and services, and last I checked, the U.S. goods and services are still the gold standard in the world, so that will benefit us. The other thing that we're seeing is really a proliferation of policies that favor local players in the markets. Some people call it localization, some people call it protectionism. And that's something that will create headaches as you continue to do cross-border transactions. The opportunity that you'll have to look at is really finding the right partners in those markets if you want to do business in Brazil, and you need to have a local partner. Working with advisors to help you identify those partners will be critical, because as much as when I was in the U.S. government, I fought against these kinds of policies that are proliferating around the world, in order to do business in these countries, you pretty much have to play that game, and you need to find the right partners to do it. The other trend that we're seeing, and hopefully if we can achieve trade promotion authority in the United States in order to negotiate these deals, you're also seeing significant trade agreements that are on the rise that certainly, if they are successful and go into force, will create great opportunities for cross-border transactions. The Trans-Pacific Partnership that was mentioned earlier this morning is one. If that gets done, that represents 40% of global GDP. It will be huge, not so much from a tariff standpoint in my view, but from some of the non-tariff barrier issues, the protectionism, the protection of IP, that's going to be critical. The other one is the Transatlantic Trade and Investment Partnership, which again isn't a tariff play as much as it is a regulatory convergence play that will help you to make more money in markets in Europe, because you won't have hopefully multiple regulatory hurdles to clear in order to do your deals. So that's my perspective, Marshall.
So it's extremely helpful to hear a political perspective, and you caused me to pivot quickly from questions about Cold War and Russia to questions about protectionism and national self-interest. And I want to ask Andy, since he's really a true China expert in this crowd. So I open up the paper today and I see once again the United States complaining, some would say whining, about China manipulating its currency for an extra 2.5 points. You've been in the China biz for 25 years. Where is the world today? Have things evolved in a healthy way in the last 5 years? Are we in a vibrant market for cross-border activity, or are we in a very dangerous market for it?
I think China is on track to increase the valuation of the RMB. Keep in mind that it's already appreciated about 35% in the last 7-8 years, and wages double every 5 years. So the costs of product and services in China are increasing. It's got a ways to go, and they are very smart. They know that almost every single country that has opened their currency up for free trading has almost totally collapsed and then over time rebuilds. And so they're going to do this very slowly and deliberately. Even though we have a trade imbalance with them, most years they actually import more than they export. Remember, for every dollar that China exports, about 80 cents they import, either raw materials or some sort of component that they get from Malaysia or Taiwan or something. So they're importing a lot of things. And so from their view, they're pretty balanced. And there are some years when it's over. But if you go over the last 10 or 15 years from just looking at their balance, now relative to the US, it's not been balanced. We have a trade imbalance, et cetera. But I'm not worried about that. And so anyway, I want to get back to the other question about the post-global crisis. First of all, a lot of our U.S. portfolio companies in 07 and 08 had initiatives to start thinking about expanding to China. And almost every one of those, unless they were already well into it, put those on hold. A lot of U.S. manufacturing, a lot of our companies in one quarter, their sales would go down 25%. So we were literally, like most manufacturing, in survival mode. We had to make some difficult decisions on cuts to survive, et cetera. And most of those firms are still trying to get back domestically where they were, and things like expanding internationally have, just not been a priority. Some of them are moving a little bit faster. In China itself, you've seen a lot of valuation gaps when you're trying to buy companies. The good news is more and more owners of Chinese companies are willing to give up control if it's a strategic deal. Standalone deals are still a little more difficult. There's a lot of these RMB funds that have risen, and they, they're inexperienced. So, that's sort of what we're dealing with.
Good. Michael, tell us a little bit about your view of the political and financial global scene.
Well, I think post-crisis financially, where you have companies with cash on the balance sheet looking to use it, or investors saying you need to use it, articulating to investors what your capital allocation strategy is key, because at the end of the day, if you're a U.S. company looking to make an acquisition for growth somewhere else, and investors think that you might as well just do a share repurchase and deliver them value immediately, that's something that's a hard current to fight in this current environment, I think, for U.S. public companies. Beyond that, if you do want to make a cross-border acquisition, let's say outbound U.S. Into EMEA or into China for growth, is where does the risk abide? Is this risk-laden growth? And for lack of a better word, and this might be controversial to those in the room, the U.S. investor is somewhat parochial. So if you're a portfolio manager at Fidelity in Boston, you don't have as much of a tolerance for political risk in China, in Eastern Europe, in Russia, as does perhaps a portfolio manager sitting in London, where there's a little more of a global view or comfort with that region. So you really have to think carefully about, if I'm going to make this acquisition, if I'm going to go out and buy growth in a foreign market, can I convince my investors that this growth is worthwhile and trumps any potential deal risk down the road, be it the deal not closing because of regulatory pressure or because of integration issues? This was a very complex deal, but we worked on the Apollo Tires transaction, which fell apart both in the States because of labor and union pressure, and fell apart in China because of a JV partner that didn't want to sell in. And this was something that, on announcing the deal, the company's market cap dropped by a quarter. So I think it's first thinking about capital allocation, then thinking about risk. And then if you look at yesterday's news, there's a big merger Monday yesterday in Europe with the Lafarge-Holcim transaction. That was a transaction, so far as I read it, we didn't work on it, that was largely about survival in Europe. You have two large champions that are coming under increasing cost pressure in the region, and they're looking at it and they're saying, we either come together and we survive, or we give up Europe altogether. So these large consolidating transactions in Europe, I think we saw some last year in telecom. I think we're going to see more in telecom as these markets mature and everybody's chasing growth. So I think post-crisis, those are the three things that we're really seeing.
Well, you guys are terrific because you're giving me all the right pivots, Michael. You talk about the Lafarge deal as a kind of survival deal in a market, not a market in a whole territory, the Eurozone, that has been in a long period of malaise bordering on distress, and in fact, indeed, in distress in the periphery countries. Japan is another story, and Brenen, maybe you can give us a little bit of color there. Japan, I would argue, I think we would all agree, has been in a 20-year recession. We thought we had a flash in the pan. They had their own merger Monday last year with a few large transactions, although interestingly, we're starting to see Japan selling large companies to the US, not something that we had generally seen as a trend before. We thought with Abenomics that it might change the situation economically in Japan more efficiently than I think it really has. But maybe we can pivot now, Brenen, to your case study, because you just spent some time in an important deal representing a middle market company in the US doing business in Japan, a very different market. So give us a little bit of color on that and how it informs the question of best practices.
Okay. Well, thank you, Marshall. It's impossible to talk about a year's worth of work and brain damage that you go through when you close a deal, but we were fortunate to have a transaction close last Tuesday. This was the sale of WB Johnston's to ultimately two Japanese firms. Because we're short on time, I think I'll just cut to what was really the aha moment in this transaction that caused it to either be a deal or not. WB Johnston's is an Oklahoma-based company that handles grain elevators, handling wheat, corn, milo. Frac sand is a new growth market for them, where they'll take frac sand in and ship it. Johnston's is an intermodal kind of transportation solution provider, so they're handling product by freight, by rail, by truck, and also by ports. Many of you might not know, but there's actually a port in Tulsa, Oklahoma. The Army Corps of Engineers drudged the Arkansas River up, and my client was operating 5 ports on that river system. So we took the deal to market, and we're fairly agnostic when we go to market. We'll market it to U.S. and Canadian and global enterprises. For a deal this size, we thought we would get an international activity. We conducted 10 buyer visits and collected 6 offers for the business. And when we received the offers, they were in the 80 to 100 million transaction range, which was well short of client expectations and frankly short of where we thought value should be. And so here's where the deal pivoted to becoming a non-deal to a deal. We did something that I've never done in my career. We had to take a step back and find out, why did we come up so short? And was it because we're transacting in really 2 different spaces, port operations and grain. And when we went back to the buyers and had those communications over a month-long period, it became very clear that certain buyers were valuing the grain asset much higher than they were the port, and ultimately vice versa. And so we ended up splitting the business in half, and we transacted the port side with a U.S. company called Oakley for a valuation that was quite pleasing to our client. A month and a half later, we ended up transacting the grain side with a company called Consolidated Grain and Barge. They're owned by 2 Japanese, 2 of the largest Japanese agricultural entities, Zeno and Atoshu. And the deal point that I want to share with you, the takeaway on this case study, is that, yes, of course, Zeno and Atoshu looked at the typical M&A metrics like EBITDA and growth and customer diversity and all these things. But what I learned in the process, and the real motivation behind this transaction and why they paid a premium and closed, was that for Japanese companies, securing food sourcing globally is on par with national defense. Because they have limited agriculture of their own, they're pressing hard to continue to acquire firms that have the relationships like my client does with the farmers and with the distribution channels in order to secure large amounts of food sourcing. So for that transaction, understanding the motivation of the buyer was the key, and also being flexible and able to split the business apart really unlocked the value.
Well, it is fascinating when you find that the transaction can change dramatically because you found someone who's coming at it from a very different angle and might accord value that way. I mentioned some years ago we were bringing 1-800-CONTACTS, the e-tailer private. The only way to bring it private was to get rid of the loss-making manufacturing operations, and the buyers for that proved to be 2 Asian companies, Menacon in Japan, who's a big private company, and Migwang in Korea. And that's what unleashed the profit flow so that we could bring it private with a private equity firm. We're rushed for time here, as was inevitable, but Andy, I know you have some pearls of wisdom that I want you to synthesize for us on best practices. You've been doing cross-border your whole career. Give us a little bit of the important learnings.
Well, that's a big thing. I think the main thing is you have to be committed, and you have to use your advisors. A lot of folks, they don't want to get the lawyers and accountants involved until late in the process. I highly recommend you do that sooner rather than later. And also try to understand the local practices. A lot of countries, what the folks do locally, we might think is unethical. And once you get comfortable, now that doesn't mean that we, at the end of the day, we say, look, we're an American firm, we can't do certain things, we're going to have to change the way we do it going forward. But we try not to judge people because they've done some of that in the past. In fact, most entrepreneurs in places like India, China, Russia, if they weren't cheating on taxes or doing other things, they wouldn't even have a business, And so to try to judge them, but most of them want to clean up, want to have proper compliance, they want to have proper controls, they want to go to the next level, and they're looking for U.S. Fortune 1000 and private equity firms that can help them get to the next level to be better companies.
And Nicole, you have an interesting perspective as a lawyer turned executive, having recently represented the ultimate Fort Knox being the United States government. Now you're bringing U.S. companies abroad into the territories that Andy's been working. Tell us what you think are the most important things that you're focusing on in best practice land.
Well, if you remember nothing else, remember this. Enter political risk into your due diligence early. You really have to get a handle on that market, who the stakeholders are. You need to map those stakeholders. You need to sequence your engagement with those stakeholders so that your deal goes smoothly. In all of the emerging markets, always remember the government, whether you see them or not, has their thumb on the scale. So you have to enter that into your analysis early. As much as you don't like it, you can't use your U.S. doing business in U.S. playbook around the world. It doesn't work. So that's the one thing. The other thing that I would say is it's very important to become, once you've, and this is kind of post-closing, to become part of the fabric of that community. What you really need to do is consider CSR opportunities in the country, aligning what you're doing with the priorities of the governments in those countries, because inevitably you're going to run into a bump in the road, and you're going to need people who will be your champions in that market. If you're viewed as someone who's taking and not giving, you'll be in trouble at that point. So that's those are the two things I'd leave you with.
Thank you for that. So, Michael, when you whether you're fending off a hostile or an activist, or doing a friendly merger on the global scale, and you're designing a communication strategy, what's the single most important thing you want to leave this group with?
If you're a public company, even if you're a private company, don't take your investors, your LPs for granted. Don't believe going in that they're going to appreciate what you're doing and support what you're doing a priori. They're not. They might not. So having kind of an ongoing dialogue with your investors and perhaps your LPs about why you're doing what you're doing in a foreign market, and that you understand the political risks, you understand the deal risks, and that this isn't just a pie in the sky chasing a transaction for the sake of chasing a transaction. Make sure that you're communicating with them so there are no surprises on the day you announce it.
Well, ladies and gentlemen, I'm required by House rules to conclude. I promised you at the beginning of this session that I thought you would hear from the best panel on the best practices. I hope you'll agree, and I want to give my own thanks, because I do agree with my own assessment, to Nicole Lamb-Hale from the Albright Stonebridge Group, and formerly from the United States government, and Foley Lardner, Andy Rice, who's always a pleasure to serve on panels with at M&A Advisors, Senior Managing Director of the Jordan Company, Michael Henson, Managing Director of Sard Verbinnen, a very formidable force in the world of corporate communications, and my new friend Brenen Hofstadter, the President of Generational Capital Markets. You've all given real perspectives on a very broad topic in a limited time frame, for which we all thank you so much.
Thank you.
Thank you.